Welcome to a comprehensive guide that will shed light on the intriguing realm of stock market investing for novices. At its core, investing is about carving a path toward financial freedom, where the fruits of your investments can sustain the life you envision. Still, dreams of beachside lounging funded by dividends will only materialize after some time. Investing is both an art and a science, necessitating patience and a structured plan. Today, we're mapping out these crucial first steps for you. Rest assured, the wisdom shared herein comes with no strings attached, no hidden courses or fees. For your convenience, we've added timestamps in the description as well to guide you to the topics of your choice. So dive in and unlock the potential of the stock market. Why invest in stocks? To truly grasp the allure of stock market investing, it's paramount to decipher the magnetism behind passive income. In the financial landscape, your earnings are categorized into two primary brackets: active and passive. The former, active income, is the conventional path trodden by many. Whether you're seated behind a desk, laboring at a construction site, or serving customers with a smile, you're committing hours to draw that paycheck. It's the classic exchange: time for money. Contrastingly, passive income operates on a different principle. Think of it as the magic of your assets, like stocks, tirelessly working for you. Once acquired, these assets continue to generate revenue without constant oversight or hourly input. This income isn't just about the money, it's about the freedom, the liberty from being tethered to a perpetual time for money trade. Investing in stocks offers a ticket to this financial autonomy. What is a stock? It's essential to begin at square one to unravel the mysteries of stock investing. So, what is a stock? Picture it as your golden ticket to a tiny slice of a business empire. By acquiring a stock, you're buying into a small portion of a company, granting you the title of shareholder. Drawing from Robert Kiyosaki's famed cash flow quadrants, owning stocks propels you to the fourth quadrant. Here, you're not just an onlooker, you're a stakeholder. But the beauty lies in the balance. You have a stake in the business success without being immersed in its day-to-day intricacies. It's ownership with a touch of detachment. How do you get started? Ready to dip your toes into the stock market waters? Let's lay out the path. First and foremost, you'll need a gateway to enter the stock market, a brokerage firm. Think of these as your trusty market liaisons, linking you to the vast ocean of stocks. Gone are the days of needing a sophisticated Wall Street broker in a sharp suit to buy and sell for you. Thanks to the digital age, it's all at your fingertips. For the novices, platforms like Robinhood and Webull are popular starting points, offering the lure of commission-free trades. But if you've got a heftier wallet and yearn for an institution with a more extensive history, Charles Schwab, Fidelity, or TD Ameritrade are top-tier choices. Getting on board is as easy as pie. If you're stateside, pop their names into a search engine, navigate to their websites, and voila! A few clicks and form fillings later, you're all set with a broker. Pat yourself on the back, you're officially in the game. 4 types of investing. This is where the rubber meets the road. Choosing the right strategy is one of the most critical aspects of successful investing. Before you dive in, it's essential to define your approach and select the stocks that align with your investment style. We'll outline 4 different investing methods and discuss their advantages and disadvantages. You can choose what best suits your situation and financial goals. But before diving deep into strategy number 1, let's take a second and show some love. Tap that like button, hit subscribe, and ring that notification bell so you won't miss out on any of our golden nuggets we're supplying. Are you ready? Let's dive in. Strategy number 1, mastering dividend investing. Harnessing the power of dividends is a strategy that captures the attention of many investors. In dividend investing, you're focusing on stocks that offer dividends, a slice of a company's profits given back to its shareholders. These payments are usually dispatched either monthly or quarterly. While dividend stocks promise a steady trickle of passive income, It's crucial not to get dazzled by high dividend percentages alone. Let's decode the art of astute dividend investing. Number 1. Understanding dividend yield. This metric is pivotal. To calculate it, you'll divide the annual dividend payment by the stock's current market price. Essentially, it depicts the income return on your investment. So let's say a stock offers an annual dividend of $2, and it's currently priced at $100 on the market. This means the dividend yield stands at 2%. Number 2. Decoding the payout ratio. The payout ratio gives insight into how much of the company's profit is paid out as dividends versus how much is pushed back into the business. A towering payout ratio is appealing as it implies hefty dividends, but be wary, it can also signify limited room for the company to grow further. Number 3. Scrutinizing earnings history. A robust earnings history is a solid indicator of a company's financial health. Your ideal pick? Companies that exhibit an unwavering upward climb in earnings. Number 4. Tracing dividend history. An uninterrupted history of dividend payouts can often be a beacon of a company's reliability. Even in turbulent economic seas, these companies steadfastly commit to its shareholders. For a practical illustration, let's spotlight Coca-Cola. It boasts a dividend yield of 2.86%. standing tall against the market's average of 1.3%. But here's a twist. Its payout ratio hovers around 82%, signaling a generous distribution of earnings as dividends. The pandemic in 2020 was a minor blip in its otherwise steady earnings, and its commitment to shareholders? Undeniable, with a history of unbroken dividend payouts since 1974. If you're scouting for other dividend-rich stocks, here are a few contenders. 3M, or MMM, with a dividend yield of 3.3%. Johnson & Johnson, J&J, presenting a yield of 2.5%. And AT&T, or T, with an impressive yield of 8.5%. Thoughtfully curating a portfolio dominated by resilient dividend stocks can be your gateway to a steady passive income. Strategy number 2. Unlocking the secrets of value investing. Journeying into the world of value investing means you're treading the path well walked by the legendary Warren Buffett. Here, the essence is simple yet profound. Seek out stocks trading for less than their inherent worth. Think of it as unearthing hidden gems or discovering prized antiques in a garage sale. The game changer in this strategy? Pinpointing a stock's genuine value. A prime tool to aid in this quest is the price-to-earnings P/E ratio. The P/E ratio acts as a window into a stock's pricing in relation to its earnings. A modest P/E ratio might hint that the stock is priced attractively vis-a-vis its earnings. Conversely, an elevated P/E ratio can signal that the stock carries a premium price tag given its earnings. Delving into resources like Yahoo Finance can swiftly fetch you a stock's P/E ratio. To illustrate, let's look at Coca-Cola. Its P/E ratio stands at 29. This suggests that if Coca-Cola earnings stand still, it will take close to 29 years to reclaim your investment. However, Warren Buffett offers another layer of wisdom. He nudges investors to juxtapose a stock's P/E ratio against the broader market's average. A stock echoing the market's average P/E ratio might not qualify as a genuine value find. Venturing into the arena of stocks often chosen by value investors, a few names stand out. Alibaba, with its global e-market dominion, Berkshire Hathaway, the very brainchild of Buffett, GameStop, with its dramatic market tails, and several banking stocks, often presenting a facade of stability. Remember, as Benjamin Graham, the father of value investing, asserted, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Your goal is to weigh the actual value, not merely to follow the crowd's vote. Strategy number 3, the allure of growth investing. Embracing the world of growth investing is like venturing into the wild. It's filled with excitement and potential treasures, but also requires a discerning eye to navigate its challenges. Here, the thrill lies in unearthing these dynamic companies on the cusp of soaring heights. often propelled by groundbreaking innovations and revolutionary business models. Spotting the game changers. In the ever-evolving investment arena, sectors like artificial intelligence, automation, autonomous vehicles, blockchain technology, and more become promising hunting grounds. But beyond the allure of these sectors lies the essence of evaluating the potential giants within them. Number 1. Revenue growth. Dive deep into a company's financials. A robust, consistent, and accelerating revenue growth can often be a beacon signaling a company's growth trajectory. Number 2. Return on equity, or ROE. It's a magnifying lens into the efficiency of a company. An impressive ROE percentage showcases the prowess of a company to effectively channel its equity into fetching profits. Number 3. Profit margins. Beyond sheer revenue, it's imperative to understand how much of it translates into profit. Profit margins cast light on a company's operational efficiency and its ability to navigate costs. Take, for instance, the electric vehicle titan Tesla. It posts remarkable revenue growth and flaunts a commendable ROE of 15.6% and a profit margin of 7.4%. In the fierce automotive arena, these metrics elevate Tesla, making it sparkle amidst formidable competitors like NIO, Ford, Volkswagen, and Nikola. However, here is a word of wisdom. While promising, the road of growth investing is also laden with bumps and turns. The stocks often gyrate with higher volatility. Hence, arming oneself with thorough research and an understanding of a company's long-term vision is paramount. As the renowned investor Peter Lynch once said, the key to making money in stocks is not to get scared out of them. Be patient, believe in your choices, and let the magic of growth investing unfold. Strategy number 4. The chill road of passive index fund investing. Let's switch gears a bit and say you want to kick back, relax, and let the world of stocks do its thing without getting too involved. Well, I have a strategy for you. Passive index fund investing. It's the cozy sweater of the investing world. Here's the lowdown. Warren Buffett, that investing superstar you've probably heard of, is a huge fan. Here's the gist. Instead of picking individual stocks, you invest in a chunk of the market. Think of it like as getting a sampler platter instead of a single dish. Examples? You bet. Let's take the S&P 500 Index Fund. When you invest in this, you're spreading your bet across 500 big shot companies in the US. Or maybe you're into tech or healthcare. There are specific index funds for those sectors too. Why go this route? Well, history has shown that these passive funds usually outdo their fancier, actively managed counterparts over time. The beauty? You don't have to stress about which stock to pick. Just find the index fund that speaks to you, type its ticker symbol into your brokerage account, and voila! And the best part? It's the ultimate Netflix and chill of investing. You set things up, then sit back and let the market do its thing. Remember, as the saying goes, it's not about timing the market, but time in the market. So why not start now and enjoy the journey? Taking the investment plunge, baby steps to success. Alright, champ, now that you've grasped these investment styles, you might be itching to jump right in. But remember, every marathon starts with that first step. The stock market? It's no different. Let's break down how to ease into this exciting world, one step at a time. Number 1, start small, dream big. Don't hold off for that perfect time or that massive paycheck. Dive in with whatever cash you're comfy parting with. It's the consistent steps that lead to significant results. Number 2, snag your first stock. Grab a stock based on your chosen investment vibe. Are you looking for some household names? Think Ford for those car vibes, Apple if you're into tech, or Coca-Cola if you're feeling bubbly. And don't stress the price tags, they're just starting points. Number 3, embrace the oops moments. Hey, no one's perfect, right? Anticipate a few slip-ups, but here's the secret sauce. Every mistake hides a lesson. Unlock it, learn from it, and watch yourself grow. navigating the world of sky-high stock prices. Okay, let's address the elephant in the room. Those soaring stock prices can be intimidating, making you wonder, is now the right time? But here's the 411. Investing isn't about today or tomorrow, but the long haul. Think less about next week and more about the next decade. When the market goes all roller coaster and nosedives, don't freak out. Take a leaf out of Warren Buffett's playbook. When everyone's selling in fear, that's your cue to buy. Seller stocks from rock-solid companies that shake things up and cater to the customers, they tend to bounce back, even when the market's having a moment. The trick? Invest with purpose and a pinch of courage, and those market jitters won't faze you. Remember, as the old Wall Street saying goes, the best time to invest was yesterday. The next best time is now. So, ready to make some moves? Wrapping it up, Investing 101. Alright folks, here's a quick recap for all you future moguls out there. Know your why, embrace the beauty of passive income. Dive into the stock basics and get friendly with a brokerage. Pick your flavor, dividend, value, growth, or kick back and chill with passive index funds. Are you doing a stock deep dive? Focus on those juicy details. Dividend metrics for dividend lovers, P/E ratios for the value hunters, and growth indicators for the high flyers. Baby steps, my friend. Learn, grow, and always play the long game. Ready to jumpstart your financial future? Then roll up those sleeves and let's get investing. And hey, if you found this info super helpful, even just a little, smash that like button, subscribe, and spread the word by sharing this video. Your friends and family will thank you. Happy investing, and I'll catch you on the next one.